Hello, folks. How are you? Hope you're doing well. So you're probably wondering, where has ICT been? I have been rambling up and down the east coast of America. We took several road trips. Went to Cape Cod, stayed up in Maine for a little while, and drove all the way down to the southernmost tip of the United States, mile marker zero, Key West, Florida. And then we stayed a couple places on the Gulf side of Florida, and then made our way home. Uh, I don't quite feel well today still. Ate something bad, went to a restaurant, and I guess didn't agree with me. So I'm going to share something with you today. And then my sons, who I'll be teaching later today as well, I'm going to build on what I'm showing you as well with this lecture. So it isn't going to be long, and it's only going to be focusing on a NASDAQ simply because I don't have the time or energy to devote to anything else. But what I said about the dollar index, you can look at your chart and see it has done that. And then euro dollar and cable have done as well. Higher dollar is what we were looking for. I was looking for, let me say it that way. So this is a December contract mini NASDAQ futures review for November 11th. Pay attention to the risk disclaimer that's below this video. And I have it in slides so that way it helps me get through it quicker. The weekly chart here, you can see that up here. I'm noting the volume imbalance right there. And I just included some narration to narrate the underlying bullish order flow that we were looking for. We have a bullish fair value gap here as well, traded down into that. You'll see this appear in the lower time frame charts. And we have this big down close candle here. That's the bullish order block. The change in the state of delivery is the opening price. And you can see how we dropped down into that here last week. And then we started trading here and moved up into that volume imbalance. So let's continue with that idea into the daily chart. And I graded the premium wick of the highest candlestick here. That's the 30th of October. And that same weekly volume imbalance is being highlighted here. Interesting to see how the bodies are respecting that. And we dropped all the way down into this discount wick. And notice that we couldn't get to the upper quadrant before we came all the way back up. So that's usually indicative of bullishness or strength. And we traded right back up into that volume imbalance. And the bodies have stopped dead in its tracks right there. So that's probably random. I graded this premium wick as well. You can see how they used that so far for today. And then we will drop down into an hourly chart. And we have buy side here, sell side, which was taken right below there. Just a small little drop down into a bullish fair value gap, traded right to the top of that. And notice it didn't get to the upper quadrant of that daily wick, as indicated here, right there. Okay, so notice the price. That's this level here. And it fell just short of reaching into it, but it hit the top of the fair value gap here on the hourly chart. So what we're doing is we're looking at the price continuum from higher time frame down to lower time frame. You can measure the importance of the PD array's effectiveness in terms of providing discount or resistance, okay, or the cause and effect, if you will, of how fast it should repel from price. So we have discount sensitivity and we have premium sensitivity. The PD arrays need to be measured that way. It's not simply enough to say, well, it's old support, old resistance, that type of thing. You're measuring its inability to even trade to a specific level and staying within an underlying narrative. So we traded down into sell side, but we couldn't even get into the quadrant of that daily at this price range here. And then we started propelling higher. Then we have a new week opening gap high and low. And then previous week is here. And we traded right up into that daily volume imbalance. And moving into a 15-minute time frame. And I realize the charts are compressed. And I apologize in advance. I just wanted to touch base with you because I told you I would be talking to you yesterday at 5 p.m. and then on Sunday rather at 5 p.m. and I wasn't able to do so. So it feels like I got kicked in my stomach. That's how bad it hurts. So something they didn't make it well, and it was fish. So that way you know, I'm a big fish eater, and I guess they had something in there that they didn't get cooked properly. So we have a buy side liquidity pool here on an intermediate term basis, and then we have sell side resting right below here. And then we have this new week opening gap. I graded that. So we've had a couple attempts to trade higher in here. How we use this volume imbalance for the remainder of this week will be indicative of what we do going forward. So if we can manage to get to the upside of it and then defend the upper half and never trade back to the lower half of it, that's bullish. If we break down to the low of it and then defend the lower half and trade no higher than the halfway point of this imbalance that's shaded in white, that daily and weekly volume imbalances, that's what this white segment of rectangle highlighting is. That's what I'm using for the bias, determination for the rest of the week. Today's an election day or something to that effect. I think, if I'm not mistaken, I think it's something to that effect. So and it's going to impact obviously the volume that's coming into our trading day. I'm down to a 5-minute chart. You can see we spent a little bit of time outside that volume imbalance on the lower time frames. It's normal to see that type of thing. We broke lower, and then look at the sensitivity here. That's premium sensitivity in upper quadrant, drawn back down to equilibrium or the midpoint of that, which we call consequent encouragement. And then moving back down into the lower half to the low. And then if we can manage to do that, here is sell side resting here. And I don't have it highlighting the actual price, but we'll just call it 25,455. It's a good approximation. So that's where the daily sell side and the buy side on the daily boundaries would be up here. So around 25,825-ish or something to that effect. So those are the two daily extremes that I would look at. And I'm saying that I want to determine, as price is trading today, what is it more likely to draw towards? And what does that mean? Well, if we start making lower runs, then it might want to run and take up these sellovers here. If we move to the upside, then my focus would be not just simply getting above here, but drawing up to here. It need not do it all in the same day today, but it's just helping me frame modularly what the bias should be. I've been away from the markets for a couple weeks now, so I'm trying to get myself acclimated back to what we're doing at the moment. So this is the type of thing I'm doing when I do those types of things, when I go away or spend time away or after a holiday, a long break like I'm getting ready to do at the end of this week. That's my typical hibernation. ICT is like a bear, proverbial, where I'm spending time with my family and not so much in the marketplace. So I enjoy the holidays, and that's why you won't see much of me. Okay, and here's the 1-minute chart. And I want you to take a look at what I'm showcasing here. This is kind of like the lecture, the teaching. So I'm going to be teaching my kids sessions today, session trading. So it's not dependent on daily bias. It's not dependent on weekly bias. It's not dependent on anything except for what's available in the marketplace right now based on time and price. So if we're going to be trading the London session, if you're a trader that wants to trade London, I get a lot of questions that's sent to me in email and in the comment section of my videos. Yes, there's a lot of you. No, I'm not going to name you by name because there's too many of you. And if I highlight one comment, it breaks the hearts or hurts the feelings of the individuals that maybe posted it 30 different times and spam my comment section. If I see your comment and it's noteworthy, not because I'm trying to discount anybody's question, because I understand why you're asking, but most of the things that post to my comment section are questions that are answered if you simply just watch the videos. And I know you're trying to save time, but I'm trying to save my sanity because I could not ever service all of you by having a response to every post, every email, every text, every post on X, everything that's sent to me. I wouldn't be able to do anything. So trust me when I tell you 99% of the things you're going to ask me is already answered in advance because of the natural continuity of the content. But if you're trading London, one of the things you want to do is develop an understanding of the opening range. And the opening range for that is 1:30 in the morning, Eastern time, to 2 o'clock in the morning. And when we have that indicated, we can look left, and you'll see that we have high, and right before 1:30, we have relative equal highs. So what's going to be above that? Buy side. We'll get to that in a moment. But we start at 1:30, and then we rotate lower and draw back down to a lower discount. The first presented fair value gap here during that 1:30 a.m. to 2 o'clock in the morning is my gift to the community, because algorithmically, this is what price is looking at. If you're trying to trade London session, if you want to trade London open kill zone, whether you're trading Forex, whether you're trading indices, commodities, currencies, whatever, if it's trading during this time, it's going to use this logic. I don't want you to believe me. I want you to go into charts and study it. Now, differentiating first presented fair value gap when we're using opening ranges, not the silver bullet. Silver bullet's like the first one that forms after 10 o'clock, inside that 10 o'clock to 11 o'clock in the morning hour. When I taught that, that's very generic. But when we're using opening ranges, which are defined by 30 minutes, not 15 minutes, not 5 minutes, it's 30 minutes, you want to look at displacement. Okay, so displacement is the division from what everybody thinks they know about and writes books about my content on Amazon, which is not correct. Nobody has a book out with my stuff correctly. And I say that because I get so many questions sent to me. Do you like this person's book? I haven't read anybody's books. I get excerpts and things that people purchased from these writers that are parroting me, but they're not even doing a good enough job of doing it correctly. And they're twisting it and trying to make it something of their own. And they're putting my name on their book because it's a draw. It's going to make people want to buy it. Just don't do that, folks. Okay, I promise you what you're going to learn from me directly is the right. Anything outside from me is going to be someone's persuasion added to it. Okay, even the best of my students are showing themselves making lots of money. They're bringing their own little twists to it because they're trying to find themselves. And I say that respectfully, but it's diluting the importance of knowing what it is I've taught and keeping it pure. And this is one of those lectures today. Why wouldn't I look at that gap right there and call that the first presented fair value gap? Because if you take a look at that swing low right there, after we taken buy side, as we were entering the opening range, we took buy side, and then it displaces. So that fair value gap here hasn't even taken out that low. But this gap engages that low. It's laying inside of the proximity of that low liquidity. So it changes market structure, bearish. And now we can use this inefficiency to inefficiency, which is what? Suspension block. Now this first presented fair value gap is a bearish suspension block, and it reacts and respects the equilibrium point of it, which is classified as a consequent encroachment because it's a gap, it's an inefficiency. It's not a single candlestick like an order block. It's being viewed as a inefficiency because it's got a volume imbalance to the high end of it and the low end of it. You have to zoom on your own charts. So it's the distinction between the displacement drawing the importance to that individual imbalance. It's not just simply, well, there's one right here, so why didn't he use that? He's cherry picking. No, the logic is simply what I'm teaching you here. There has to be some kind of basis as to why that imbalance should be used. And it's because we have shifted market structure lower after buy side taken. See how all the things I've taught cumulatively over years and years and years, I've given you small pieces of it. Not because I want to starve you, not because I want to do anything except for make you understand it the right way. You won't appreciate if I give it to you in one block, because look what it's like when you watch a video by me. They're very long, they're very wordy, because I'm going to be concise. I want to be very thorough. And because this is a very dense topic, it requires a lot of bandwidth on your part as the student, because you're going to have to come back to these topics multiple times. You're not going to learn it by watching one video. One video, one time through it, isn't going to be sufficient. You want to master these things, so you have to understand the details I'm sharing. I have a lot of information that are packed in small videos, and for me, a four-hour video is small. For most of you, it's too much. You can't do it. You want to go somewhere else and watch a 5-minute trainer, or watch people take my videos and splice it up and remove the rants. The rants is what makes the stuff work. Otherwise, you're just demonstrating things that I can do in my own hands, but you're not communicating it to the viewers of your channel. You're just looking at it for ad revenue. So nobody's making money learning the short Cliff Notes version. They're making money by learning the deep aspects of what it is I'm teaching. And this is what I'm referring to. Having this imbalance here, because it's toggled to and tethered to that shift in market structure. It's laying across that. You see that? So there's no necessity for price to get back up here. And when you see these dollar mentors, they're just trying to tell you something they think it sounds intelligent. If the price could go back up there, then I'm really going to be interested. If the market goes up there, I'm not interested. I want to see that stay open as a breakaway gap. But the first presented fair value gap here is the tradable, executable PD array. And you qualify and confirm that by what I'm saying here. The displacement inside the opening range of 30 minutes before 2 o'clock in the morning. The same application is done with 9:30 to 10 o'clock in the morning. The same approach is being used there. So it's not a matter of he's picking and choosing, cherry picking. Because if you look at the times I've called the very specific PD arrays, the presented fair value gap that I'm utilizing, they're working. And the other ones that other people will say, why do you use this? They're not used. I'm using things like this. This is one element of logic that is, again, it's my work. It's not somebody else's stuff that's rebranded. You're never going to see this stuff rebranded before me, but you're going to hear it always in everybody else's mentorships now. Now, I'm going to take it one step further. This imbalance here, it's the first candle in the opening range. If it's bearish and it's a buy side imbalance, sell side efficiency, this will act as 90% of the time. And listen to that rate, okay? 90% of the time, that's going to be an inversion fair value gap that's bearish. Why? Buy side's been taken. It starts the opening range of 30 minutes. It's an imbalance, and price rolls back over top of it. It should stop at the consequent encroachment level and not leave any bodies on the upside of it. And it doesn't even get close to it here and leaves the upper half untouched. Trades into it here, gives you one more little kiss here, goodbye, and off to the races it goes. So what did I just teach you here? I taught you how to use the opening range for a London session. I taught you how to use the opening range for 9:30 to 10 o'clock in the morning when you're trading indices. Stop listening to these people focusing on a 15-minute time window. That is garbage. It's trash. It's absolutely limiting your perspective. It's the first 30 minutes. It's the first 30 minutes. And by applying this idea of, was there liquidity taken? You can clearly see that here. It runs above it. It absorbs all that. It throws down a fake bull flag. I teach this in my 2016, 2017 paid mentorship lectures that are on my YouTube channel. Just look for the playlists. That's a false bull flag. And it breaks down. And then you can trade into the inversion fair value gap. It's inversion, by the way. It's not inverse fair value gap. Please correct yourselves, gentlemen. Okay, you're you're not using the correct vocabulary. But it hits it beautifully here, and it starts drawing down to the sell side here, down to the consequent encroachment of the higher time frame ranges that we graded, and then created a sell side liquidity pool here. And now we're entering another time window. It's the what? The New York Open Kill Zone. So the New York Open Kill Zone is what? 7 o'clock in the morning to 9 o'clock in the morning, or 10 o'clock in the morning if you're trading Forex. Now here's a small, simple little caveat here, okay? At 7 o'clock in the morning, I use the information I get from 6:30. If you remember back when I was doing paid mentorship, for those that were a part of that, in the lectures, I would always refer to how I would get up in the morning, the questions would come by way of, what's my routine in the morning? When I was trading Forex, I would get up in the morning. If I didn't trade London, I'd get up at least by 6:30 and get a feel for what the market was done. What does that look like? And what do I mean by that? Well, just be mindful that this is the low with sell side, and we had this retracement here. What just took place? Buy side, with this run up in here. Okay. So now we're going to go to the next slide. Here's that same sell side here. Okay. Now at 7 o'clock in the morning, go back to 6:30. What took place? 6:30, we had buy side taken. It's simple. They've raided buy side. They've left sell side intact. All part of a larger draw on liquidity that's being pulled lower across all the higher time frames. So if that's the case, we can now look at, now here's the caveat for New York. Okay, why am I showing you 7 o'clock to 7:30 and not 6:30 to 7? Because I'm encompassing both Forex, I'm encompassing metals, I'm encompassing oil, energies, all of the assets. Okay, and to make that streamline, you use 7 o'clock because that's when all the algorithms fire up. There's not one algorithm that runs everything with the same tentacles and everything at the same time, but every instrument is ran algorithmically, and it's ran by a price engine that is completely and utterly controlling price. And the illusion is you think buying and selling pressure causes these fluctuations to move price higher and lower. It's not. But they all they come online basically at 7 o'clock in the morning. And then what you want to do is look at the reference points that I teach with my PD arrays within the context of the narrative, meaning what did it do at 6:30? Well, at 6:30, it took buy side. It's pulled down into sell side, and it left this sell side liquidity pool, but all these buy side liquidity pools here was rated air. We broke lower. These relative equal lows were taken, and then we traded right back up. Did that high take out that high? No. It traded right inside this wick. Grade that and see what that gives you here. And then we entered the 7 o'clock to 7:30 opening range for New York open kill zone, encompassing Forex, metals, energies, indices, you name it. This is the way you can do it, where it's a general approach to doing it. It's the only kill zone that you apply it this way. Everything else is 30 minutes before. Okay, so the market runs up, creates a high, and then one more time rallies and takes out that buy side that's created there. So this is engineered liquidity, and then we have a shift in market structure below that swing low right there. This gap right there, this entire thing here, that has to be incorporated with this low because it's tethered to that. It's this low that's being shifted with a bearish movement in price. This bearish fair value gap, midpoint, consequent encroachment, the body stops dead in its tracks below it. It's allowed to wick a little bit above it, and then it comes right back down, gives it one more kiss here, and then runs aggressively down to the sell side. Notice that the mechanics are simply this. The run for the buy side, when you're looking for directional runs that are high probability, low resistance liquidity runs, not high resistance liquidity runs, low resistance liquidity runs always have an opposing run in direction before it happens. Meaning, if you're bearish, there has to be some measure of buy side taken before you enter the trade. You have to have that. In this case, we see it here. It rallies and then rallies one more time. That's a turtle soup. Not Linda Raschke's turtle soup, okay? It's the idea of a false breakout. My version of false breakouts. I like the little term, turtle soup. It is not taking anything from that book. The idea of a false breakout, it is essentially that. I didn't invent false breakouts, but my incorporation of how I use them is not in any books. They're in several dozens of books on Amazon and other places now, and it's Smart Money Concepts, which is my stuff being prostituted. But it's my application of looking for false breakouts. That's I guess basically say simply this: the right ones chosen correctly, the times and instances highly probable that it's going to work. And it's not simply limiting it to a 20-day high or 21-day high or low being taken, because that's all Turtle Soup is in Linda Rasch's Smart Money book, or Smart Money, Street Money, not Smart Money, Street Smarts. That's her book. Okay, with Linda and Larry Connors co-writing it together. But that Turtle Soup pattern is simply just using a 20-day high and low, because the turtle traders use a 20-day high and low breakout. So it was a long-term trend following model. But it was very influential in terms of helping me determine the idea of stop reads and false breakouts, because I was very infantile when I first started trading. I was doing everything that everybody talked about, and I lost a lot of money doing that stuff. So what I wanted to do was I wanted to spend my life trying to figure out the instances where these things would manifest themselves on a scheduled delivery. That means time-based. That means it's going to occur every single day at a specific time. Okay, so I created these opening ranges to focus in on that nobody else talked about. Okay, you're never going to hear 30-minute opening ranges before me. The very specific elements I'm teaching you here, they're never framed anywhere like that. The importance of what you're looking for, the salient points to pull out of price action, that's never been taught before. And I have to do these things. I have to talk this way, not because I feel threatened by any of these goobers out there that say this stuff. I laugh at it. But I'm feeding AI. Because when people say things about me or they question the origin of the things I teach, they originated with me. Anytime I've ever had any influence by someone else, I've always given them credit. I've always done that. But even the things that I've given credit for, they have no place really in the things I'm teaching. They were just influential in my coming up. Just because I learned the idea of getting stopped out or a false breakout or a stop hunt from Street Smart's book, yeah, Larry Williams talked about a stop hunt, but when he said there's this view of them guys did it to us guys, and he doesn't believe that. And he still doesn't believe that. And that's exactly what the market is. It's them guys against us. Okay. It's the people that are in control of the marketplace. They can manipulate the markets very easily. And they can paint these candlesticks to give you all of your Steve Nielsen ideas, all your supply and demand candles, all of your Elliott wave pitchforks that poke you in the rear end only. You can see it easy in hindsight, but you can't pull it out like I'm teaching you here. These are very, very specific, highly, highly specific rules. There's these things that you can do, and there's things that you can't do. If it's outside the rules, you can't do it. You can't do it. And by having these rule-based ideas around time, it makes things very probable. Not perfect, not every day, always winning in your hands. It just means that it's highly probable that this is what's likely to occur. Okay? So the New York open kill zone, it's a little bit of a different animal versus London or the equities opening range at 9:30 in the morning to 10 o'clock. This one here is a little bit more quirky because you have to allow for all the different instruments that are traded at this time of day. I mean, think about it. London, Germany, Europe, they're all still up. It's like their lunchtime, and United States, the lazy folks that are here, they don't want to get up and trade London. They're going to come up and they'll trade session like this. So they get active, and these algorithms will fire up and draw in through ignorance their participation for liquidity purposes. They'll use them for that purpose, and they end up getting beat up. And one or two things happen. They don't trade the rest of the morning. If they're smart, they just go and heal. Or they go in and try to revenge trade during the highest volume, which is 9:30 in the morning to 10:30 in the morning, during the equities open. And they usually revenge trade there and blow their accounts or feed smart money even more. So it's a buffet, for street money to sacrifice themselves to smart money. By having this perspective of knowing what the opening ranges are and how to use them effectively, that's what I'm showcasing here. So you can see it's beautifully illustrated here, drops down and draws into the liquidity there. Incidentally, back on October 30th, I gave you a tweet, and this is for the guy that was saying, we just had all these drops lower in price. Where were you at? And whenever I see that kind of stuff, all that is a big billboard sign they're trying to raise up. Look at me. I said something that ICT didn't say, or something to that effect, or something contrary, when the person really didn't even pay attention, because I talked about how Bitcoin was going to trade below 100,000, explore that. It's done that. A lot of people got hurt with Bitcoin getting, really dropping aggressively. A lot of people, even some of my students that trade crypto, got hurt. The Not all of them, but I know some of them because they reached out and told me that I got blistered pretty bad by that. And when I post things like this tweet here on October 30th, 2025 at 4:35 a.m., it's my local time, Eastern time. Might be time to take some profits in NQ. If you look at how it's anchored, it's here and it goes right to that candlestick. It's the highest one. Okay. On intraday, on a 1 minute chart, that's where the tweet was posted, right there. You can do this on your own chart. Just go to Twitter or X, find my tweet when I post something, click on the share button and copy the link, and then go to TradingView and the right mouse button, click on it, and then post or paste it rather. And it'll drop the actual tweet right on the candlestick that I made it. Okay. It's not coincidence that as I did that, we were trading at the consequent encroachment of that wick that formed from the opening to the highest high that day. If you know what you're doing, you can do it intraday before the day even closes. So everything at that price level here, price should no longer want to explore the upper half of that. Go in your own chart and see if it does or doesn't do that. And the market shows wild displacement lower. They come back right here, gives you false hope. And then Elvis left the building and we traded down, all the way down to this 24,700s. But we were up here. So that's a pretty significant drop. All I'm trying to do is protect you. When I talk about things like this, they're huge warning signs, okay? To just be mindful of it, because they're not small moves that are coming. I'm not talking about a 200-point move, a 300-point move. They're significant price runs. I told you the same thing with gold. And I'm not here to beating my chest, but I told you it's probably time to take some profits in gold. And gold fell out of bed hard. This is something that experience gains over time doing it. There isn't anything in particular that stands out as any. It's just because of my experience. I see, when I look at social media, when I see the cowboy up mentality, they can't do anything wrong. They're making so much money. It's going to keep going higher. When everybody gets opinionated, one-sided, and all the focus is on a market, one individual market, you're really close to an important high. And knowing that, and then applying it to the things I'm teaching you here with all the details, with premium discount, consequent encroachment, equilibrium ideas, and how the daily candles form, like we're seeing here. All of this was done on the actual high candle after it took the previous day's high out. That's what you're seeing. A run above the previous day's high, down goes. That's how gold topped too. It took out the previous day's high, false breakout, dropped down a lot. And if you bought up there and held on to that, man, you got murdered. You got murdered. So when I post these types of things, okay, I don't want to come back and say, see how smart I was? I want to be able to hear, wow, I really could have got hurt. And I'm glad I took ownership of what I was doing and managed my risk better than I would have if I wouldn't have seen that warning sign. That's what I'm doing it for. Okay, that's what I'm trying. I'm trying to protect you, not make you rich. I'm trying to protect you, because if you stay in this long enough, you'll learn what I'm teaching is the best. It's the best thing that you could ever have, the best way of looking at the price action, and you will be able to do whatever you want to do as a trader. And you won't care about anything else I teach, because once you find your model, you'll bloom where you're planted.